Welcome to the Liquidity Event, a show about all things personal finance with a laser focus on taxes, financial independence, and equity compensation. Hosted by AJ and Shane of Brooklyn FI, each episode will focus on a personal finance topic, some driven by news headlines and sometimes driven by listener questions. And sometimes you'll just get two money nerds rambling about what they think is interesting. Just a quick note before we get started, this podcast is for informational purposes only and should not be considered tax or investment advice.
Hello, and welcome to the Liquidity Event. We're your hosts, AJ, and I've got Ed with me here today. This is episode 140, being recorded on March 12th, airing on March 21st. Wow, big gap there. A quick reminder for you listeners, we will answer your questions on the pod if you leave us a message. You can disguise your voice and use a fake name if you're shy. That link is memo.fm/the liquidity event. Today on the show, I've got Ed, who is one of our financial planners here at Brooklyn FI. We are here to talk about the markets, and we're also here to shit on Dave Ramsey, and we'll talk about Taco Bell. How are you today, Ed?
I am great. I was going to come in and say, hola, AJ, ¿cómo estás? Maybe it's Shane a little bit, but I realized my Spanish knowledge was not at the level of his, so this was going to end pretty quickly. But I am doing great. We're in the middle of our tax season here at BKFi. I know this is going to air a little bit after, but my daughter's birthday is tomorrow on Thursday.
Happy birthday.
So very exciting stuff going on here. Going to get some balloons, but life is good. How are you, AJ?
I'm good. And Ed, remind folks where you live in the world.
Oh, yes. I am in Philadelphia, Pennsylvania. And, we're still high off of the Super Bowl win, but things are
Did you
things
win
are
the
changing.
Super Bowl?
Yes. Well, me personally, I guess I guess so. The Eagles are a part of the Philadelphia as a whole. So, yes, me personally, I feel like I've won.
Congrats.
Also. Thank you.
Seems like a big deal to folks who. So, yes, congratulations to you.
Yeah, sports matter, AJ. Sports matter.
Well, there's something, speaking of events that are very important, Taco Bell recently held their, I don't know what this was, but it was basically a Taco Bell event. It seemed like they were kind of trying to emulate Apple. Apple doesn't participate in any industry conferences. They just have their own conferences where they do product launches, new launch of the iPhone. They roll out the new Apple Watch. So it was called Live Más Live. It was supposed to happen in LA, but because of the fires, they moved it to Brooklyn. And TLDR from this conference, big new exciting product launches. We have a grilled cheese burrito with shredded beef coming in 2025.
That's the one that really caught my eye because there was a grilled cheese layer in there. So I was like, oh, man, okay.
A grilled cheese burrito. Yeah, that's kosher, right?
I think so.
And their big promise is that, of course, you got to put AI in your press release. So big innovations coming with AI in terms of customer data, being able to recognize you and your preferences. And I did check the Taco Bell stock price, which is owned by Yum Brands, had a little bit of a spike. I don't know if it was related to this event. It seemed like the spike happened a little bit before. But I love that this is a very creative marketing idea.
Yeah, absolutely.
Let me ask you something, Ed. How often do you eat Taco Bell?
Ooh. Probably haven't had Taco Bell for the past, 7 years or so. But my wife and I, then girlfriend, we used to go there all the time. Yeah. But I don't know. I'm a Chick-fil-A person food wise, so I don't know. It's been hard to replicate that at any other establishment.
I see. That's fair.
But they also Taco Bell here says they have crispy chicken nuggets. I didn't even know that was there.
They're bringing them back. Them back.
Well, I guess they left.
Yeah, I guess that was not on my radar. I used to eat Taco Bell a lot in college, but since spending more time on the West Coast, I'm more of a Del Taco girl myself. Although I do have a Taco Bell baseball hat that my husband got me for my birthday a couple years ago. That's this khaki hat with this very sleek little logo, and I love that hat. And when I wear it, people ask me if I work at Taco Bell.
Yeah, I was wondering if that was the purpose, or do you just love the brand?
No, I just love the brand. I don't know. It was just I love the hat, and every time I wear it, people are like, "Oh, did you just get off work?" No. I
mean, they could. Are you the CEO of Taco Bell? I don't know.
Right,
they could have.
Yeah. Anyway, I just thought that was funny. I love when. Yeah, I mean, food is huge, right? Food is a huge part of. Yeah. The economy here, and I mean, a lot of people rely on Taco Bell as we talk about inflation, cheap food that is easily accessible. This is America runs on Dunkin' or America runs on Taco Bell.
I am interested to see what the AI Taco Bell is going to look like. What is it actually going to preference? Because they're being extremely vague as to what AI here is going to do. But I kind of love it. I was like, are you going to pull up to a drive-thru and be like, hey, Ed, you ordered this stuff 6 times last night at 2 a.m. Yeah. What is going on in your life? Maybe you need this other service.
Well, I don't know if you have this You're in a big, I was going to say in a little town like Philadelphia.
Oh, okay. Okay, I see you, Brooklyn.
But if you order Uber Eats here,
Yes.
like the other night I ordered like Thai food or something, and it was like, do you want to add something else? So basically, like I could order Thai food, but I know I'm going to be hungry later. So you can add on Taco Bell as like a stop, or you can add on like, get your dessert somewhere else.
Yeah, we have the same thing. You can add convenience orders. Like if you're going to get, you order Thai food or something spicy, it'll say, hey, CVS has Pepto or something like that. Are you sure you want to make sure?
Yeah, that's not AI, dog. That's common sense. Anyway.
Yeah.
Speaking of common sense, folks, we had a pretty big, scary market correction, a lot of volatility in the stock market. Kind of started over the weekend with this invented trade war. And Monday we saw markets moving around a lot, and it was scary for most folks. If you read the headlines, you would have been scared. U.S. lost $4 trillion. The U.S. market lost $4 trillion in one day. Huge correction responding to trade war. We're headed for recession. All these big, scary headlines. But if you have common sense, or you have Ed as your financial planner, you know that we don't get spooked by these scary headlines, these temporary. I mean, I don't want to call it a crash. This was not, in the scheme of things, this wasn't a crash, but it was, the market dropped significantly. If you checked your 401k balance on Friday and then checked it on Monday, you were in for a scary, scary number.
Especially if you were invested in the S&P or held the Big Seven, which have basically lost all their gains since the election or given back. So, yeah, completely understandable, but I think we all understand that this volatility is, there's a lot of uncertainty going on right now in terms of our policy, and companies don't like that. Companies like to make long-term decisions, and the stock market is just a reflection of the fact that we're not sure what's going to happen. It's been 20 days since the inauguration, or almost 2 months since the inauguration. Felt like 6 years of policy and moves that have been done, but we have to think about it from a goals perspective and think about it in the long term. And these are the kind of the articles we're going to get into.
It's just interesting. It's like when that happens, obviously at BKFi, like in our Slack channels, all the financial advisors start going like, all right, here we go. Like gird your loins, wait for the client emails to come in, wait for the client phone calls to come in. But they don't, right?
They really haven't.
Once in a while, we get a call from a client who's freaked out. And of course, we'll always take that call. But like, our philosophy is we're not investing for tomorrow. We're not watching daily moves in the stock market. We're looking at 5, 10, 15, 20-year returns. Yeah. So a little blip is a buying opportunity, right?
Yeah, exactly. Yeah, no, we don't look at short-term volatility. We're not stock pickers. We look at your goals and what the portfolio is invested for. If it's invested for the next 30 years or for your retirement, we can look at charts that are presented in these various articles, but drops happen. Drops happen on a daily basis. The market, it does go up and to the right, but within, there's always a bunch of drops and wiggles that happen.
I'm going to share my screen, which is going to be wacky for those of you who are listening, but we'll do our best to talk through it. But if you're watching on YouTube, which you should be, because you can see Ed's fabulous daughter's playroom and his punching bag behind him. Looks like you got some trophies back there too.
Those are chess trophies. Yes,
chess
absolutely.
Trophies. Hell yeah. Oh yeah, Ed, you're a big chess player, right?
I do partake. I used to play a lot more in tournaments when I was younger, but now I'm just one of your average schmoes.
When was peak Ed? What was your highest chess ranking and how old were you?
Oh, that's too embarrassing. I think it was like 16 and I was maybe like 1400. This is not like not grandmaster status, nothing like that. It was good. You can find me on the Chess Federation website if you know how to spell my name.
That's Zolotarev. That's Zolotarev.
Exactly. But I think my first name is the thing that's misspelled. So that's
Eduardo.
Exactly right.
Just Ed Z.
Just Ed Z. Just Ed Z. Don't Google me.
So what we're... Stay away from him, ladies. Okay, so what we're looking at here is a timeline of the U.S. stock market starting in 1870, which I think is really silly because we don't have a ton of data. Looking at 1870 data, trying to compare it to 2020 data is silly. But really around 1920 is when we start to get reliable data. The stock market resembles something like what we have today. And we are looking at a trend line showing the growth of $1 and the U.S. stock market's real peak value. So basically, if you invested $1 at the beginning, how much would your dollar grown? So if you invested $1, it would have grown quite a bit, right? Almost to $20,000 over a 150-year period.
Yeah. Yep.
But what we're really looking at is these crazy global changing events like World War I. Heard of it? the first major global pandemic, influenza, right? Was that 1917?
Yeah, I think so. Yeah.
17. Then we have the famous 1929 crash and the Great Depression that followed, ruined a lot of people's lives, sent this country into a major, major recession. Then we come out of it. Then we have World War II. Then the post-war, there's another bear market, meaning we have flat growth. Like all these horrible things happened. Cuban Missile Crisis, Vietnam War, Black Monday, that was 1987.
Watergate.
Watergate. Yeah. The lost decade, which is basically, right before the dot-com crash, we were heading up and to the right. Then we see the dot-com crash. Then we had the 2008 financial crisis, 7 years later. And it wasn't until really like 2013 that we started to kind of come back. So we do have this, long, 10-year period from 2001-ish to 2011, 12-ish, where we didn't see a ton of growth. But that's only 10 years. In the scheme of your life, that's not very much, right?
Yeah,
so
exactly.
Whenever anyone texts me or anything, it says I'm freaked out about the market. What should I do about my 401k? I just send them this chart and I say this is you, and this is how much life you have left. You're not going to live for 150 years, but hopefully, at our age, everyone's got at least another 50 to go.
Right. I mean, here's hoping, right? Yeah, and I think you bring up a good point, right? It definitely obviously depends on your age and the portfolio you have. People our age, this really shouldn't be an issue. We're investing for the long term, for the next 30, 40 years of your life. When you're going to be looking back at this in 2060, I don't even know if we're going to remember what happened today or yesterday or what the market. This graph is just going to have a little bit more up to the right and a little bit more wiggles of whatever we're calling this.
Totally.
But for individuals that are in their retirement phases right now, yes, this is something you should have been looking at, and the portfolio should have been reallocated to be more conservative, knowing that you're going to need the money sooner. But
exactly. Yeah. If you're 70 right now and you're sitting on $300,000, you need that money to not go down, right? So you can't afford a lost decade right now, right? You need to take some risk off the table. You can't be invested 100% in the S&P 500. We know that. However, if you're not 70 and you're 30 or you're 40 or you're 50 or you're even 60, you still have time to be invested aggressively in the market. And that's just something we see over and over again is people go, oh, I'm not aggressive. I'm more a conservative investor. It's well, what does that mean to you? Right. Yeah. I hate that question, Ed, when, a typical financial advisor will say, how much risk tolerant, what's your risk tolerance number? How risky, how would you feel if your portfolio lost 20% value overnight? It's I don't know. I think if I had $10,000 invested, I feel a lot differently if I had $10 million invested. Yeah. So I don't know how to answer that question.
Yeah. And the other hand is all that means is you just have more money in your emergency fund and in cash. That money shouldn't be invested in the first place if you're literally that conservative and concerned about the daily, market movements or need the cash for an upcoming expense.
Yeah. And, earlier you were talking about how, hey, is this an opportunity to put more money in? The market's quote unquote on sale. It's less expensive than it was last week. Should we, if we have extra cash on the sidelines, should we be putting it in? Should we try to wait for maybe the market, maybe we haven't seen all the volatility. Maybe this trade war is going to increase. Maybe next week there's going to be even more of a drop. Should we wait till next week? And as you and I both know, because we've studied the markets, we don't like to time the markets, right? We are not smarter than the U.S. stock market. And I want to show another chart here. I love this chart from, let's give credit where credit's due. It's from this website called The Age of Data. And this chart is called Timing the Market, Why It's So Hard in One Chart. And basically we are looking at the value of $10,000 invested in the S&P 500 from January 2003 to December 2022. So recent-ish history. And basically this chart says if you kept your $10,000 invested all this time, you just put it in the market and just let it ride, at the end of this period, you'd have $64,000. But if you tried to time the market and you tried to take your money out and you missed just the 10 best days in that long, what is that, almost 20 year period, if you missed just the 10 best days, you'd have half as much money. You'd only have $29,000. So this chart is basically telling us, keep your money invested because you never know when the best day is going to happen, when you're going to get the highest gains. And honestly, those highest gains days often happen after our lowest lowest losses. Immediately after the worst days. We actually have a chart on this in some of our slides, and that's why our philosophy is about time in the market versus timing the market. I've heard you and Shane say this on the podcast a bunch of times, but that's something we say all the time to our clients to get them prepared, that we are not trying to time anything. And you honestly, if you are trying to time it, you have to get it
right twice, right? It's the entry point and the exit point, which is incredibly difficult, like as this chart shows.
Totally.
So,
and remember, like we're looking just at one index here. We're looking at the S&P 500, which is not the whole U.S. stock market, which is not the whole global stock market, right? We're looking at one specific index. You can buy an index fund that will represent this. But that's the other thing about charts and graphs, folks, is we could pull whatever data we want to show whatever we want. Like if I want to show you how investing in this stock is a good idea, I can pick and choose this start and end point of my data. So at the end of the day, the best thing you can do is own a bunch of stocks, own the whole market. As we saw before, it goes up and to the right. Now, is that going to be the case forever and ever? You know, clients say, well, sure, but given the current political situation, we're likely headed towards World War III and everything's going to blow up in our faces. Why should I invest at all? Ed, what's your answer for that when a client says that?
My answer to that is the same as we show the same graph when we talk about the year-long. Your investment horizon is longer than any potential events that are going to happen. And if there is, unfortunately, going to be a World War III, we do have data for what World War II looked like. And you could kind of look back and see, like, yes, it was a terrible time, but you have to look past it. But the other thing is, we're probably having if there's World War III, we'd be having other conversations aside from investments and things that are happening.
Absolutely.
Like not being,
Quick question.
drafted. Yes.
Do you know how to shoot a gun, Ed?
Yes, I do.
You do?
Yes.
How many hours would you say over your lifetime have you spent practicing?
I've been to a shooting range once. That's about it.
All right. So we were at the same level. So my girlfriend and I have decided we're going to take shooting lessons. So there's an Orvis tour about 2 hours upstate. So that's my summer 2025 project.
I mean, honestly, look, we have questions sometimes about what happens if the U.S. goes to war and all the other things. I mean, we'll talk about investments a little bit around that, but I think we probably need to have other conversations about what you need to do around that time. I think it's worthwhile. I think it's it's fun sometimes too to do it. It's like the shooting ranges can be pretty fun.
Yeah, I mean, it's just interesting, like thinking about like the history of the market, and we see these big crashes when we look at the long-term time horizon. We see these huge crashes, then we see these huge rebounds, right? 2008 was was devastating, right? A lot of people lost their jobs. A lot of pension funds invested in single companies went to zero. People lost their retirement, lost their homes. Homes were foreclosed upon. But generally, if you had money in the stock market and you kept it there, it only took you, 4 or 5 years to get back to where you were before, and in some cases even less, depending on when you got in.
Yeah, I believe it. I think you were able to triple your money within the next 10 years if you just left it in. So it was, absolutely. It's people, those that left the market in 2008. Same thing happened in 2022 when we had that big drop off. People left the market or were concerned. And then there was an immediate pickup at the end of 2023. You would have already made that money back, plus the additional gains that happened around that time. So it's all about time horizon and really thinking about your personal goals. I don't think people need to panic. I think we've done a great job with our clients because we haven't been getting that many emails about people wanting to exit because they understand the long-term strategy that we have, and it's all really goals-based. Like, what do you need the money for? If it's meant to be long-term, don't look at your 401k every day. It's not meant to be there. It's not meant to be.
And remember, the economy is not the stock market, right? So right now we have, inflation. We just had some data come out on, I forget which way it went, but interest rates, right? Interest rates are coming down. Hey, if you're thinking about refinancing your home, maybe now is a great time to lower that payment and change your cash flow. It doesn't necessarily, just because your stock market portfolio is doing poorly doesn't mean the rest of your financial life has to go up in flames too. Yeah,
exactly. It's, I completely agree with you there that the stock market's not the economy. It's just the feelings of a bunch of it.
Just the feelings, just the vibes.
It's just feelings. Yeah,
but
just vibes.
It truly is. I mean, and I think one of the best examples of that are these meme stocks, right?
Exactly.
I love I don't like what's happening, but I kind of love the meme stock idea because it is actually such a great lesson in how markets work. A company its stock is not doing well because it's the best company. It's about demand from the market to invest in that company. Exactly. So a lot of people misunderstand this is a bad company. I don't like the board of directors. Why are they doing so well? It's because people want to invest in them and they see the long-term potential value. Or in this case, a bunch of guys on the internet were like, this would be funny.
This would be fun to do. Right? Exactly. Yeah.
And let's make the market. That is such a great lesson. Now I understand. Now I have skin in the game. I actually understand how supply and demand works.
Exactly. And in the end, the market is just a combination of all of us are coming up with what we think the price is, right? And some people use technical models and some people are like,
Vibes.
I like it. I like the stock, right?
Yeah. I mean, I also love all the videos on TikTok where it's like, here's my chicken who's going to pick my trade for the day. And this guy sends his chicken, like literally a live chicken, like down the stairs. And it's like, chicken picks a card. And it's like, okay, we're going to bet on the 9th stock on this list. And the chicken picks, call or put option. Oh, chicken picked green. So we're going to do this like kind of option.
I mean,
and they puts in the chicken trades and the chicken's done pretty well.
Yeah. I mean, I guess that's as good as any, and it's entertaining. So I don't know.
Yeah. And there was the octopus too a couple years ago.
There was the octopus
who was
there was
doing
also
really well. Yeah.
there was also monkeys that shoot darts. So that was a good one.
That was a good one.
So all kinds of ways.
I prefer to rely on the money making machine of the entire U.S. economy than a chicken on the internet.
Right,
personally.
exactly. And I don't think any of them have done as well as the U.S. market. That's kind of been the whole point. The point of all of those videos is they do better than active managers. So, which has been the real. Going back to the original point, if you try to pick stocks, it's hard to do so.
That's even worse. Speaking of the U.S. economy, you shared this article with me. This is from UBS, and it's the Global Investment Returns Yearbook for 2025. And basically it's talking, I just found this interesting because we focus so much on the U.S. as a market maker and a market driver of the global economy. What is it? The U.S. makes up 64% of the total capitalization of the world markets.
Yes.
But that wasn't always the case, right? We used to be behind.
Yeah, absolutely. I mean, in the 1990s, before Japan went into its lost decade, they were 40% of the entire world market. And then we had the dot-com boom and shifted.
Oh my God. I would do anything to die and come back as a mid-tier business executive in Japan in 1992. I feel like I was just like destined to be that person.
Really?
like wild, like parties, like cocaine fueled nights in Tokyo,
I mean, you could just kind of do that here in the 80s. I feel like so.
Sure. But Japan would just be cool.
But you're right. The
music,
culture,
incredible. Yeah, vibes, food.
Oh, the
music.
cultural vibe would be 100% different. Yeah,
so good, so good. The clothes. Anyway,
maybe.
So, which is all to say, and the U.S. it makes up a larger percentage of the market, but not as much as people think, right?
Exactly. We invest in the U.S. Most people invest in the U.S. 100% of their portfolio, or if you're investing in the S&P, that is the 500 of the U.S. companies. But the U.S. is only 64% of the world. Now, it is the highest market cap of all the countries, but it just goes to show that that hasn't always been the case, and the case for diversification is still there. We're seeing it now, where the U.S. is taking a giant hit, and the S&P 500 and the top 7 stocks are dropping off substantially. But small caps, international stocks are not dropping off as well, and that's the whole kind of idea. Is that's why we invest in the entire market, not just the U.S. entire market, but the entire global market.
Oh wait, I got one more chart for you. Hold on,
yeah.
I'm gonna pull this up really fast. It's a quilt chart. Have you seen these?
Yeah, absolutely. Yeah, where it talks about the.
Yeah. Let's find one of these. Yeah, so a quilt chart basically shows us each type of asset class and how it performs each year. And if you look at each one lined up year by year, so we start on the left, we go, 1990, we can see it looks like a quilt. It looks like a beautiful, colorful quilt because it's not U.S. small cap stocks do not do the best every year.
Yeah.
Sometimes it's international bonds, sometimes it's gold, sometimes it's cash, and it's a great visual representation of the fact that stocks we just never know what's going to happen.
Yeah, there isn't one consistent asset class that does well every year, and it basically just makes another case for diversification because you never know. You're never going to know what market factors are going to drive it.
Yep. Well, I wasn't fast enough to pull it up, but we'll link to that in the show notes. Yeah, just Google quilt chart, folks, and you'll see what we're looking at.
Yeah, absolutely.
What else you got for me? Oh, let's shit on Dave Ramsey.
Let's talk a little bit about what it means to manage money and how some people perceive. Dave Ramsey is an interesting guy overall.
We're talking about him, and I think that was the point of him saying this ridiculous thing that he said. So for those of you who don't know, Dave Ramsey he's one of the biggest syndicated radio shows. He talks about money. He helps people get out of debt. Financial advisors, the consensus is that a lot of his advice is bad. A lot of his asset return assumptions are way off, and he's kind of a blowhard. I think he's kind of like a sexist, weird asshole, but that's a whole other show. And this clip just got released of him on his radio show.
And that was that's his clip. That's not like something he posted on his.
Yeah, and we're talking about it, so good for him. Yeah. But basically, someone asked him a question. A reader wrote in and said, you've talked about owning.
Yeah, basically the reader asked, like, is it ethical for you to own multiple rental properties when you know you're contributing to the housing crisis, right? One of the issues is that we don't have enough housing, and because a lot of it is investors are buying up properties and renting them out instead of converting them into low-cost homes.
Right, so people can't afford rent anymore, basically,
Exactly.
because we've had these, people who want to make money, and they have made money, ruin the markets, basically. It's
Yes.
not just one person owning a house and renting it out to someone else. And so this person, and Dave goes, I own 15 to 20 houses, but I don't own anything. God owns it, and I am managing it for him. So I guess you're calling God greedy now. I'm managing money for God.
Yes, that is what he said. I don't know exactly how to respond to that. But then he also went on to say that, the fact being materialistic is against Christianity because that's a heresy, which contradicts the fact that he doesn't own anything.
Yeah, I mean, this is such a dangerous argument. I mean, this is so dangerous, right? It's like, well, let me just justify anything I do because it's God's will, right? That's where we get into danger. And he's basically saying, just because I got chosen to make money, I should make more money because it's for God at the expense of the 20 families who live in the homes that I rent out to them.
It's a dangerous precedent for any kind of develop. Obviously, unfortunately, we've had violence, right, in the name of God and things like that. And this is just another thing to say that, well, I'm just managing money for God. I mean, I don't know. What's God paying you? 2%? I'm trying to understand how this works. Is God diversifying investment advisor, or does he have all his money with you? I'm confused by that statement in general, because you're trying to tie this. You're trying to absolve yourself from the responsibility that you have in this issue. You're not as much as Blackstone or any of these other obviously hedge funds investors, but still there is a responsibility there.
What did he say? Oh, he said hedge funds don't have a soul, but he has a soul. Blackstone doesn't have a soul, but he has a soul, so it's okay for him to buy up rental properties.
Right, as if Blackstone isn't managed by a bunch of other human beings that also are so. I don't know. It's when I first heard that, when you sent that over, I didn't exactly know how to respond, because I was just if you start saying that God is now chosen you to do anything, it is very hard to have a discussion kind of after that, because then any decision that you're saying has been ordained. And so then if you don't believe in that, then how do you even have a rational conversation about anything?
Yeah, it reminds me of the Middle Ages and the Dark Ages churches, where the church would come in and say well, you can't talk to God, only we can talk to God. And everyone was like, oh, really? Okay, well, I guess we have to pay you 50% of our income to be able to ask you to ask God to give us something. So
my other favorite, last thing I will say, that he was whenever you get TikTok advice, it's really bad. And he's like, and then the host goes, well, you're on TikTok. And he's like, well, yeah, it just goes. I was like, all right, well, see, there's already so many hypocrisies and contradictions. There's so much mental gymnastics that has to go in to be able to justify that position.
Which I think, he's sort of, he's calling himself out for basically saying, don't listen to idiots on the internet. And he's an idiot on the internet.
He's an idiot. Exactly. Yes, exactly.
And so are we. I don't think we're idiots on the internet. I don't know. We're just talking. But sometimes I'm an idiot on the internet, and that's fine. And I think that's why in times like this, and I say like this, and it's funny, John was making fun of us. He's like, you're doing a show about the markets 10 days before you're releasing it. It's like, no, this is evergreen. We're recording this today. I assume there will be at least 3 other, stomach dropping market dips before the end of the year. This episode, my opinion remains the same.
I 100% agree. And if you want weekly updates, our managing partner, John, actually posts weekly market updates on LinkedIn. So if you want things that are a little bit more pertinent to that the previous week or the next week, you can see that. But I agree with you, AJ. We can re-record this podcast as is, maybe without Dave Ramsey, unless he says something else stupid. But it'll be exactly as relevant as it would be in the next market drop. And we'd be having the exact same conversation. What are your goals? What is the long-term diversification? Don't put your money in the S&P only.
And it sounds so boring. That's the thing that always I come back to is I tell our clients, I'm so sorry. Our strategy is boring, but it works. Find something else to talk to your friends about. Get a hobby. Talking about which stocks are performing well or what meme coin you're buying. That's a hobby. That's not your net worth. We shouldn't be playing with our net worth like that. So
exactly. And
look, I get it. Our clients and people are sick of hearing just set it and forget it. But that's the answer, folks. Make sure you're accounting for taxes and make sure you're being smart and make sure you're optimizing. But at the end of the day, put the money in the market and put a barrier between you and yourself so you don't panic and pull it all out at the wrong time. Because as we saw earlier, pulling it out and missing even a day or two, that's going to be a much bigger influence on your ability to get wealthy than paying someone 1% or less to manage it.
And one of those barriers is, hiring BKFi. Like we look at this stuff every day. We're the ones that look at the market trends and seeing what's going on. And we then help you make sure that you're staying on your path. We help you manage the emotions that you may have if you're looking at something every day.
And it's not even the emotion. Like, it's just like having someone to call and say like, hey, am I okay?
Yeah.
And the answer is yes, but let's have a conversation about it. Let's remind ourselves. And sometimes I need reminders. Like, as you grow your net worth, those drops get a lot bigger and a lot scarier.
Absolutely.
Right?
Absolutely. Especially if you're not diversified. They get very big, very fast.
Exactly. I mean, all my money's in BrooklynFi anyway. So.
There you go.
Well, Ed, it has been such a pleasure having you on the Liquidity Event. Thank you so much for listening. Folks, you can email us your financial problems at liquidityevent@brooklynfi.com. Leave us a voicemail at memo.fm/theliquidityevent, and we will play it on the air. And finally, Stans can leave us a review if they want to be worried about it. We will see you next week. Thanks so much for listening.
Adios.
Bye.